HIMS stock, the hypergrowth telehealth company, has gone absolute bananas over the past few months. In my previous video on HIMS, titled The Messy of Telehealth, I talked about the disconnect between the company's valuation and intrinsic value and why I believe HIMS stock is extremely undervalued. At the time of the video, which was about 4 months ago, HIMS was priced at $23 a share. Fast forward a few months later, HIMS stock has ripped through both my base case price target of $45 a share and bull case price target of $62 a share. However, as we've seen in the past couple of weeks, HIMS stock had lost about 50% of its value, down from $70 a share to about $36 a share as of this video. So in today's video, I want to discuss HIMS fundamentals based on its recent Q4 results, why the stock is selling off, and of course, at the end of the video, I will give you my updated price target on HIMS stock. As always, you can read the article version of this video, which I will leave the link in the description box below. And with that being said, let's get on with the video and look at HIMS and Hers Q4 results. Alright, starting with the most important growth metric, HIMS grew its subscriber base by 45% year over year in Q4, ending 2024 with about 2.2 million subscribers. On a quarter over quarter basis, HIMS added 182,000 net new subscribers, which is the second highest in a single quarter. So this growth was driven by the expansion of personalized treatments on its platform. And for those who are unaware, personalized treatments are healthcare solutions that are tailored to unique individual needs, which involve multi-condition offerings, personalized dosage levels, and differentiated form factors. And these solutions are customized with the goal of optimizing health outcomes for subscribers. That said, subscriber growth is very important as it is a leading indicator of future revenue growth and subsequently earnings growth. So seeing strong subscriber growth reflects increasing revenue potential for HIMS, so that is always good to see as an investor. More importantly, each new subscriber added into the platform strengthens the HIMS and Hers platforms by building higher brand trust, increase data collection, and accelerate product innovation, which lead to higher quality outcomes, which in turn lead to even more subscribers joining the platform, thus delivering this flywheel effect that keeps on growing and improving the platform. So as a result of rapid subscriber growth, revenue for the quarter was $481 million, up by a whopping 95% year over year, which beat analyst estimates by $11 million. As you can see, growth continued to accelerate in Q4, marking the third consecutive quarter of growth acceleration for HIMS. So this hypergrowth was mainly driven by the recent launch of its weight loss offering, which currently includes oral-based solutions as well as compounded semaglutide GLP-1 injections. As you know, branded GLP-1s have experienced nationwide shortages over the last few quarters, which is why many consumers turn to compounders like HIMS for compounded GLP-1s, thus generating significant GLP-1 revenue for HIMS. So as a reference, HIMS generated approximately $225 million of GLP-1 revenue in 2024. So 2024 total revenue including GLP-1 was $1.5 billion, up 69% year over year. On the other hand, revenue excluding GLP-1s was about $1.2 billion, up 43% year over year. So in other words, GLP-1 sales drove 26 percentage points of growth in 2024, which is a lot. Nevertheless, 43% growth for its core offerings outside of GLP-1s is still an impressive growth rate, reflecting the platform's growing ability to enter new specialties and scale rapidly, which positions the company well to serve tens of millions of individuals over time. The unfortunate thing is that nobody really cares about the company's past results. All investors care about is where the company is heading, more specifically the company's guidance and how its weight loss business will evolve given the GLP-1 drama that we've seen recently. So management's guidance is the most highly anticipated part of the earnings report, so I'm going to spend a little bit more time on guidance because I think a lot of people are confused with their guidance and whether it includes GLP-1 sales or not. So on a very high level, management expects Q1 revenue of $520 million to $540 million, implying a growth rate of 87% to 94%, and this beat analyst estimates of about $495 million, as well as full year revenue of about $2.3 billion to $2.4 billion, implying a growth rate of 56 to 63% year over year, and this also beat analyst estimates of 2.1 billion. So for comparison, full year 2024 revenue growth was 69% year over year. So if we take the midpoint of management's guidance, full year guidance, we get about 60% growth in 2025, which is incredible given the company's much larger scale and tough year over year comps. Also worth considering is that management has a history of sandbagging guidance, so don't be surprised if its 2025 revenue came in higher than what management guided. So with that in mind, this full year 2025 revenue guidance included at least $725 million of weight loss revenue in 2025, which is about a third of total revenue. And that is a lot, so let's dive deeper into this number and find out what it consists of. So during the earnings call, CFO Yemi Okupe gave a little bit more clarity in terms of their weight loss revenue guidance. So according to management, that $725 million figure excludes contributions from commercially available dosages of semaglutide and instead includes primarily of their evolving oral-based solutions as well as liraglutide and personalized semaglutide dosages, which will be supplementing these core offerings of oral-based and liraglutide. So if you're unfamiliar, liraglutide is the first FDA-approved generic GLP-1 solution and injection, which is projected to launch later this year on the HIMS and HERS platform. Now, if you're wondering why management is not including contributions from commercially available dosages of semaglutide, well, that's because in February this year, the FDA resolved the semaglutide shortage, which may constrain the HIMS ability to provide access to compounded semaglutide on its platform once their current inventory has been sold. In addition, CEO Andrew Dudem recently made a post on X giving more details about the semaglutide issue. So he first began by stating that the FDA has recently announced that it was removing semaglutide from the shortage list, which for some HIMS investors that will mean a disruption of their service. More specifically, commercially available dosages of compounded semaglutide will no longer be available after mid-May, which consists of 0.25 milligrams, zero point 0.5, 1.7 milligram, and 2.4 milligrams of dosages. So these customers with these dosages, they will not have access to compounded semaglutide on the HIMS and HERS platform, and therefore their plans will be cancelled and they will be provided a refund for unused fills. On the other hand, customers on a personalized dosing regimen of compounded semaglutide treatment will continue to be available through the HIMS and HERS platform with no change. So in short, commercially available dosages of compounded semaglutide will not be available on the platform, whereas personalized dosages of compounded semaglutide will still be available on the platform. So if I read everything correctly, management's guidance of weight loss revenue of at least $725 million excludes commercially available dosages of semaglutide, which is why this category is blackened out right here in their investor presentation, even though they can still sell these drugs until mid-May, which should easily be worth hundreds of millions of dollars for hims and hers. On the other hand, the guidance includes personalized dosages of semaglutide, liraglutide, as well as oral-based solutions. So the biggest risk here is that HIMS may face a potential ban on selling personalized dosages of semaglutide. While personalization and customizing dosage levels and tinkering with these dosage levels allows HIMS and hers to bypass commercially available dosages of semaglutide, it is undeniably a gray area in the pharma industry, which could lead to an outright ban from the FDA. The good thing is that management seems to be confident that they'll be able to continue to offer personalized dosages of semaglutide without meaningful conflict, which is why they have included personalized dosages of semaglutide in their revenue guidance. However, if a ban on selling personalized GLP-1s go into effect, it will really hurt the revenue outlook of the company, which will surely hurt him stock as well. That being said, if there's really no conflict in the personalization department of the business, I think management is severely sandbagging their guidance since they're not including the sales of commercially available dosages of semaglutide, which they can still sell until mid May. Whatever it is, I'm not too worried about the short term volatility caused by the GLP 1 drama because the HIMS investment thesis never really revolved around GLP 1 drugs in the first place. It's just a nice to have. Besides, its core business outside of GLP 1s is still growing rapidly at 43% year over year growth in 2024, and the company continues to gain market share in the telehealth category, now boasting a dominant market position of 47% plus. So with this kind of growth rate and leadership position, I think it's only a matter of time before HIMS reaches 10 million subscribers. And as the company continues to delight customers and expand to new categories, I think HIMS has a good chance of being a household name, eventually amassing more than 100 million consumers or subscribers in its platform. Looking at the company's profitability, Q4 gross profit was $370 million, up 81% year over year. While HIMS maintained strong gross profit growth, gross margin was 77% in Q4, which dropped 6 percentage points year over year. And as you can see, gross margin has declined for the fourth consecutive quarter. So this was mainly due to the higher costs related to the addition of the new weight loss category, which was launched in Q4 of 2023. Additionally, lower prices on some of its weight loss offerings have also pressured gross margin. For instance, HIMS recently dropped the price of its oral weight loss solutions from $79 per month to $69 per month, and its compounded GLP-1 injections from $199 per month to $165 per month. And with this recent price cut, HIMS now offers the lowest annual cost of GLP-1 weight loss subscription plan on the market at about $1,980 per year, which is much cheaper compared to its largest telehealth competitor, Ro, which has its GLP-1 plan priced at more than $4,000. So with this kind of affordable pricing strategy, not just for its GLP-1 product, but also its entire product line, I believe more consumers will join the HIMS and Hers platform, thus leading to robust subscriber growth for many years to come. That said, as HIMS continues to lower prices, we can expect gross margin to continue to decline further. However, this should be offset by economies of scale as the company expands further. As a matter of fact, management expects gross margins to start to recover in Q2 this year as the company gains scale efficiencies, so that's really good news for investors. Despite declining gross margins, adjusted EBITDA still improved on a year-over-year basis. So in Q4, adjusted EBITDA was $54 million, up 163% year over year, and this represents an adjusted EBITDA margin of 11%, which improved 3 percentage points year over year. So the improvement in adjusted EBITDA was driven by operating leverage across all its expense lines. Most notably, HIMS continues to gain marketing leverage, with marketing expenses as a percentage of revenue dropping 5 percentage points year over year to 46%. And moving forward, management expects this percentage to continue to decline as the company drives 1 to 3 points of marketing leverage per year over the next few years. That being said, given its relatively low market share compared to big pharma and given the massive market opportunity for HIMS, I believe HIMS should maintain aggressive marketing stance so as to maximize subscriber growth and product adoption. Besides, judging by their performance over the last few years, I think HIMS has been incredibly efficient and effective with their marketing, so I'm not too concerned if, let's say, the company decides to splurge on marketing. Speaking of which, HIMS had recently spent tens of millions of dollars for a 60-second ad slot during Super Bowl 59, and guess what? The ad was a huge success, ranking as the number 5 most effective ad among the 94 brand ads aired this year, driving 7.7 times as much engagement as the average Super Bowl ad airing this year. So while him spent a boatload of money on its Super Bowl ad, I believe the value it gets in return should be many times more. I believe this Super Bowl ad alone will result in massive subscriber growth in Q1. That being said, as a result of its strategic pricing actions and marketing investments, expect some pressure on adjusted EBITDA margin in Q1, but just like gross margin, expect it to improve in Q2 and beyond. So in Q1, management expects adjusted EBITDA of 55 million to 65 million, implying an 11% to 12% adjusted EBITDA margin. But for the full year, management expects adjusted EBITDA of 270 million to 320 million, implying a 12% to 13% adjusted EBITDA margin, which is a slight improvement from their Q1 guidance. With this in mind, I think management is sandbagging their profit guidance. For one, they have a history of sandbagging guidance and outperforming them. And secondly, as I've explained earlier, I believe this adjusted EBITDA guidance does not include revenue from commercially available dosages of compounded semaglutide, which they can still sell until mid-May. Whatever it is, the most important thing is that HIMS continues to drive operating leverage while reinvesting for future growth, whether it be in new products, additional marketing campaigns, more employees, bigger supply chains, or better technologies. And as HIMS continues to scale, I expect the company's profitability to improve over time, which should lead to explosive earnings growth for decades to come. Now, turning to the company's balance sheet, HIMS has $300 million of cash and investments as of Q4, with zero debt on its balance sheet. And this was an improvement of $46 million quarter over quarter, as you can see right here. But as you can see, its cash position has been growing over the past few quarters, which is very good to see. So the increase in cash was driven by free cash flows of $60 million in Q4, which grew 452% year over year. And of important note, Q4 free cash flow would have been higher if not for its $15 million acquisition of Medisource, which is the company's first 503B compounding outsourcing facility. That being said, here's a chart of HIMS's free cash flow on a trailing 12-month basis. And as you can see, HIMS free cash flow continues to improve with each passing quarter. So as of Q4, trailing 12-month free cash flow was $198 million, which grew 322% year over year, representing a free cash flow margin of 13%, which is up 8 percentage points year over year from 5% last year. With robust cash flows and high cash in hand, management decided to put their money to work. More specifically, management announced the acquisition of not one but two more companies in Q1. So first, HIMS acquired an at-home testing facility, allowing subscribers to perform at-home blood draws, and other whole-body testing. This will enable HIMS to collect even more data and health insights from subscribers, allowing HIMS to provide even better, even more precise personalized treatments for subscribers. In addition, it will accelerate the company's expansion to other health categories like low testosterone and menopausal support. The second acquisition in Q1 is a US based peptide facility which further verticalizes and strengthens its domestic supply chain. Additionally, this facility will give HIMS the platform to explore peptide innovation, including pain management, longevity, and muscle recovery. So, considering all these recent acquisitions, HIMS is turning into a more vertically integrated telehealth company, which allows the company to control every aspect of the value chain, including customer service, product expansion, and drug formulation. Importantly, HIMS will gain access to even more data across even more areas of the value chain, which will make the company's AI more intelligent, more capable, and more efficient. So while lower prices and higher marketing spend and two acquisitions will drive free cash flow down in Q1, I believe these investments will solidify the HIMS growth story as it built itself into the healthcare platform of the future. Let's now talk about the company's valuation. As you know, HIMS price action has been extremely volatile over the last few years. So just this year alone, HIMS stock is up about 48% year to date, and at one point it was up nearly 200% when it reached an all-time high of $72 a share. So I think extreme undervaluation, exploding fundamentals, and the GLP-1 hype serve as mega tailwinds for the stock. In addition, the Super Bowl ad and the lab facility acquisition triggered a short squeeze as HIMS stock broke past its previous highs of $35 a share. However, the stock sold off violently following the FDA's announcement that semaglutide will be taken off the shortage list, which was bound to happen anyway. Moreover, a federal judge has denied a motion over the FDA's decision to declare the end to Eli Lilly's Zepbound shortage, which means that we will likely see the same thing happening for semaglutide. And this news alone sent HIMS stock down by more than 15% in a single day. And now the stock is trading at about $36 a share, down about 50% from its all-time highs. But despite the sell-off, the stock is still up 48% year to date and more than 100% in the last 12 months. So I can't really complain here. But as you can probably tell, HIMS stock is extremely volatile, and I have endured this in the last few years, so this is nothing new to me. But what I do know is that volatility creates a wonderful buying opportunity for long-term investors. For instance, considering the recent sell-off that we've seen, HIMS stock now trades at an EV to revenue multiple of just 5 times, which is much more attractive than a 10-time multiple a few weeks ago. And on a forward basis, HIMS stock is trading at an EV to expected 2025 revenue multiple of about 3.2 times. So considering HIMS' incredible growth rate and improving profitability and expanding moats, I believe a 5x multiple or 3.2x forward multiple is very attractive from a risk to reward standpoint. In the meantime, financial institutions are loading up on HIMS stock, and as HIMS continues to scale and improve its fundamentals, I believe more and more institutions will join the HIMS party, thus pushing the stock to higher and higher levels from here. So here I have a screenshot of my DCF model. So if you're interested, you can go ahead and pause the video and have a look. But let me give you a quick walkthrough of my key assumptions. So for revenue growth, which is the first row right here, I expect a 62% growth rate in 2025, which is near the high end of management's guidance. In the following years, I expect growth of 30% in 2026 and then gradually drops to just 15% by 2032 and beyond. So I think my growth assumptions are very conservative in my opinion. As for cost of revenue as percentage of revenue, I'm projecting it to be about 25% margin in the long term. translating to a gross margin of 75%, which is in line with management's guidance. For operating expenses as a percentage of revenue, I expect it to drop from 75% in 2024 to as low as 55% in the long term. So with these assumptions, I expect 2034 revenue of about $12 billion with an operating margin of 20%. So if we add back depreciation and amortization of 1.5% and stock-based compensation of 3.5%, we get an adjusted EBITDA margin of 25%, which is at the midpoint of management's guidance of 20 to 30%. That being said, I project a long-term optimal free cash flow margin of about 20%, which is not crazy at all since the company already has a free cash flow margin of 13% with ongoing operating leverage. So considering all my projections in the previous slide and assuming a perpetual growth rate of 3% and a discount rate of 12%, I get a base case price target of about $70 a share for HIMS stock. And as you saw in the previous slide, my assumptions are quite conservative, maybe too conservative given the company's track record of strong execution. That being said, I believe the company's intrinsic value per share to be about $70, which is about double from its current price of $36 a share. In short, despite being up more than 100% in the last 12 months, I believe HIMS stock is still severely undervalued with significant upside potential over the next decade. The stock could definitely drop further to the 200-day simple moving average, which is about $25 a share, but I think the risk to reward is already good at $35 or $36 a share currently. Having said that, I'm putting my money where my mouth is and recently added to my position following the recent sell-off. And if it drops further to $25 a share, I plan to add to my position even more. So to wrap up this video, let me summarize my investment thesis on HIMS following its Q4 results. So the company has done nothing but execute, execute, and execute, and HIMS continues to attract more and more subscribers into its platform, further expanding its market share position, which is now nearly 50% of the telehealth market. And this is a testament to the company's value proposition, brand, and technology. And despite its incredible growth profile, the company still has a massive growth runway ahead as it only has 2.2 million subscribers as of Q4, which is only a fraction of the United States population. And given its current momentum, I wouldn't be surprised to see HIMS achieve a 10 million subscriber base by 2030, which is in about 5 years. Not only is the company growing rapidly, but it is also growing profitability with margins expanding and cash flows at record highs. And it is also worth mentioning that HIMS has no debt on its balance sheet, so it is in a very strong financial position. It is also reassuring that management is confident about the future of the company as they continue to invest heavily for future growth, including 2 recent acquisitions to expand their supply chain and product offerings. But unfortunately, HIMS is currently caught in a GLP-1 drama. And while the investment thesis has never revolved around GLP-1s in the first place, the end of the semaglutide shortage had caused a violent sell-off of 50% in the last few weeks. On the other hand, now that the semaglutide shortage is over, investors can now focus on its core business, which by the way is still growing at 43% in 2024. And what's more, management seems to be sandbagging their guidance as they are not including the sales of commercially available dosages of semaglutide in their guidance, which HIMS can still sell in Q1 and Q2. So I expect HIMS to outperform expectations throughout 2025. Having said that, I remain very bullish on HIMS stock with a 12-month price target of about $70 a share, and considering its recent pullback, I believe this is a generational dip buying opportunity for investors. With that being said, thank you guys so much for watching this video. I hope you find value in this video, and if you do, please leave a like, comment, and subscribe to my channel for more investment content like this. As always, I appreciate you and I hope you have an amazing day. See you guys in the next video.